You are definitely a crypto bro, but an atypical one, which helps the rest of us.
I'm not a crypto bro. I'm a Bitcoin. That's the other thing, don't fall into the natural trap, which is, we've seen this time and time again of the new currency, the new Bitcoin, a much better, faster Bitcoin. It doesn't exist. There's only one cryptocurrency, which is Bitcoin.
Who the f am I to tell you what to do with your money?
My name is Priya Malani, currently managing millions of hardworking dollars. Enough foreplay. Let's talk
Money.
welcome to the F word. Smart money.
No bull.
Hey guys, welcome to the F word. I've got a really good one for you today. He's my former colleague from Merrill Lynch. This guy can price options with the Black-Scholes model by hand in his sleep. He has done like a billion triathlons. He's got his MBA from Yale, did time at Goldman Sachs, Merrill Lynch, Deutsche Bank, and then he moved home to Brazil, where he served as a CFO for a lending tech company that he helped found before exiting and getting into Bitcoin. Now, his company is the largest private Bitcoin mining company in the world. Needless to say, he knows Bitcoin inside and out. Today, he's here to convince us that Bitcoin deserves a place in your portfolio. Raphael Zagury, welcome to the show.
Thanks, Priya. Very happy to be here. Glad we're having this conversation. Finally, we're talking about Bitcoin.
Finally is right. I've been looking forward to this conversation for a very long time, and you are the perfect person to have it with. So I'm really, really happy to have you today. So as we've discussed in preparation for this episode, this is going to be a Bitcoin 101. But before we get into that, can you give us a little bit of your backstory on Bitcoin? After years on Wall Street, what got you interested enough to turn Bitcoin into your livelihood, and when did this all begin?
Yeah, I like to joke that, I was a Bitcoiner even before Bitcoin started because I was born and raised in Brazil. And through the late 80s, beginning of the 90s, when Brazil was experiencing hyperinflation. And when I say hyperinflation, it's this wild, crazy inflation to the point that, would literally lose money from one day to lose value from one day to the other, right? So I knew the fact that, hard money was extremely important. At that time in Brazil, just to give you an idea, everybody would price everything in dollars because that was the standard of hard money for Brazilians, right? So anybody that could get their hands on dollars, we get our hands on dollars because it would keep value much better than the local currency. Crazy stories, just very quickly. I remember like my mother giving me money for lunch money for the school, and she would give me like bills, and she would tell me like, don't bring the bills back, whatever you have left, just spend, get a candy, get something, because if you bring the money back, tomorrow is going to be worth less than it was worth today, right? Supermarkets were like packed in the first of the month because everybody received their paychecks. And the first thing you do is that you convert your money into hard assets. So you would actually go out and buy, a lot of groceries. Brazil had this culture of massive supermarkets up until today because of that. Because on the first of the month, it was packed with people trying to buy groceries, and then the rest of the month it was empty, right? So it shaped me, and it shaped, I think, the Brazilian culture in different ways. It is also why I ended up, studying economics. I really wanted to understand why that was happening. Embarrassingly, it took me a degree in Yale to figure out that money printing was at the root of all of it. But it's true, right? I think that, the more money is printed, and there's a philosophical and fundamental issue with that, which is the fact that you and I, we have to work, we have to be spending time here, we have to actually put our efforts to earn something, to get capital, to get money, right? I keep saying that money is a memory of work because that's what it is, right? It represents something that you actually done in the past, and that's how you store the fruits of your labor. And at the other side, you have governments, and banks, entities that can just press a button and print more of it. So it just doesn't, for me, it never seemed like a fair system. I kept looking for an alternative for that, right? And I think the world looked for an alternative, right? We came from the gold standard, which was, the first try of something that could work. And when I saw Bitcoin, it resonated with me, I think, for several reasons, but most of it because of the hard money nature of it. It's the first digital hard money that you actually have. It can't, it has a limited cap. 21 million. The rules are written in code. The other thing that I think, I was born a Bitcoiner because I always loved programming and coding. So being able to read the monetary policy in code, for me, of course, it's beautiful. But there's more to that. The fact that it's transparent, it's mutable, right? Anybody can read the code. You can download the code today and can see exactly what it is. Good luck doing that with any other currency, where the case of the US, you have, the Federal Reserve, which is 9 board members that, close together in a board meeting that you don't know what's being discussed. You don't know what's behind their decision making. And they're literally deciding for the monetary outcome for the world, right? Not only for the US, for the rest of the world. So back in 2015, answering your question, around 2015, 2014, even before I came back to Brazil, I left Merrill, I went to Deutsche. And when I was at Deutsche, I remember, reading some stuff about Bitcoin. Like most Bitcoiners, I ignored it for a long time. My first reaction, governments are never going to let this happen, right? If it gets big, it's going to get banned. Second, how can I really know that, there's only going to be 21 million? It just sounded for me like magic internet money. And I ignored it. But, then time and time again, it came back. And I remember, and this was around 2015, I had one of the guys that I really followed that talked a lot about, the Fed, monetary policy, macro, that he wrote about, and he was a gold bug. He still is a gold bug. And, he for a long time, he kept saying, the gold standard was really what was important for the world. The fact that we broke the gold standard led to all of these issues. And when Bitcoin came out, he was a huge proponent of it, John Malden. And John kept saying this is, for me, it's like digital gold. It has all the characteristics of gold. The only one that it doesn't have is it doesn't have a track record. But it will be built with time, right? And when I read that, and this was right after Bitcoin had a massive blow up. That's the other thing of the asset class, is highly volatile, and we can talk about that. But it had just collapsed. The price went from $1,000 to $300, and it was more the trader and me looking at it price is much cheaper now. I actually should buy some. Funny story about that. I bought a little bit, should have bought more, but didn't buy enough. This was the end of 2015. Then at Deutsche, we had an annual review of what we were thinking about for next year, the investment thesis for the next year. And that year, the big team was thinking outside the box, thinking about new investment opportunities. So I brought Bitcoin for for the investment committee at Deutsche. And needless to say, that didn't go well. That conversation lasted maybe 3 minutes. They're no, this. They had the same reaction I had the first time. This is magic internet money. We can never put this in a portfolio for our clients, right? And fast forward now to where we are, and Deutsche actually, in fact, includes Bitcoin in the portfolio of their clients. It is part of their asset allocation. So a lot has changed, and a lot has happened in the last 15 years, right?
Wow, that is an incredible story. My gosh. So 2015, really more interest developed, but it really sounds like your childhood laid the groundwork, laid the foundation for you being open to a new type of system.
Yep.
That's insane. Magic internet money. Well, yeah, I think that's really well said, because Bitcoin feels like a game to a lot of people, and for others, it's just plain intimidating, especially high earners who feel like they should understand it by now. So I just want to start with if someone is listening and they think okay, I'm smart, I make good money, but I still don't really get Bitcoin. Is that pretty normal from what you see?
Extremely normal. It's, I would tell you, most people, they approach Bitcoin exactly like that. There's one thing, Bitcoin is multidisciplinary, because for you to really rock Bitcoin, and by the way, I've been reading, studying, about Bitcoin for more than 10 years, and I still think there's a lot for me to learn, right? There's always something in the technical side to learn, in the philosophical side. And to that point, I think it encompasses at least 5 different disciplines you should be thinking about. One is economics, which we talked about. The second is computer science, which we talked about as well. Then there's a little bit of sociology, philosophy that encompasses it as well. The fact that we've talked about, trust minimization. Bitcoin has rules without rulers. It's something very different than the traditional system that we live in. Unfortunately, some people actually want to have, they want to have a central bank. They want to have somebody controlling their money. They want to have to trust in someone. This is a twist and a different way to look at things, where you have, as I said, rules without rulers at the end of the day, right? You have math. A lot of the cryptography, it's based on mathematics and how it's being set up, right? And you also have physics, and this is the part that goes into mining, about converting energy into proof of work, right? Into cryptography and all of these different things. And as you approach Bitcoin, you tend to approach from the angle that it's the most comfortable for you. So if I talk to somebody that comes from the computer science background, they are going to start asking questions about hash functions, distributed networks, like the technical part of Bitcoin. When you talk about somebody that comes from the economics background, the finance background, which is where we come from, right? They will ask you the macro, the monetary policy questions, the inflation questions, right? The game theory, time value of money, all of that, and trying to understand from that perspective. But to really grok Bitcoin, I think you need to understand a little bit of each, because it's something very unique and very different from other assets that we've seen in the past. Now, I struggled with this for a long time. As I told you, like in 2015, I tried to explain this to financial folks. They couldn't get it, right? And in some cases, I actually took a complete different approach. I'll tell you one story. There's a very good friend of mine that, I talked to him about Bitcoin for a long time, hedge fund investor, has invested in hedge funds for a long time, invested in everything, big investor, right? So think about a typical Wall Streeter, right? Traditional. And every time I told him about Bitcoin, he would just he didn't even want to listen, right? Completely disregard it. So I did something tricky. I printed to him, I got, this was a while back, maybe, I don't know, 4 or 5 years ago, but I printed to him the returns of Bitcoin in a sheet that looked exactly like a hedge fund manager, right? So it had like the monthly returns, the drawdowns, the volatility, the Sharpe ratio, an analysis just like if it was a manager. And he looked at it and he immediately looks at the returns. Returns were very good. Sharpe ratio off the scale, right? So Sharpe ratio, just to make it non-technical for people to understand, it's a way to measure returns, on the basis of risk. So what you do, if you just say, oh, it went up 10%, it doesn't tell you the full story. You want to know how volatile it was. It's one thing to go from 0 to 10 in a straight line. It's another to go to 0 to 10, something extremely choppy, right? With high volatility.
I sometimes explain Sharpe ratio as miles per gallon. So how much return are you getting per unit of risk?
It's exactly right. And, so when he looked at the Sharpe ratio of Bitcoin, that got his attention. Like there's a Sharpe ratio that at that time was close to 2, which, not even Berkshire Hathaway, Warren Buffett, they have that Sharpe ratio, right? So he immediately asked me, like, oh, so who is this manager? And I thought, well, listen, this is Mr. Nakamoto. He's a secretive guy in Japan. You're not going to be able to talk to him. His fund has been closed for a long time. There's no way you can get access to him. And he immediately got it. It's like, oh, this is Bitcoin, right? And I'm like, yep, this is the returns on Bitcoin. And he looked at me, he's like, yeah, maybe I have been overthinking this. Maybe I've been thinking about this in the wrong way, because think about how crazy this is. If this was a hedge fund manager that will give me no transparency on the allocation, what he's investing on, what actually his portfolio is composed of, I would have invested, with my eyes closed, right? While if I have a protocol that I can actually see how the protocol is running, I have all the transparency in the world. Yeah, I don't know all the market dynamics about who's buying, who's selling, but I don't know that for anything, right? But I would have invested in it, and the fact that I'm actually have more transparency on this, it's hurting it, right? Going a little bit on a tangent here, but it's a little bit of the paradox of transparency, right? Sometimes when you have more transparency, it leads to more questions. In the short term, it leads to maybe a little bit less trust. But because you're going to have, visibility into everything, you're going to see that when things don't work, when things work, right? While if you have something opaque where you just see beginning to the end that I don't tell, yeah, I went from, this city to this city and I got there safely. You have no idea to understand, if you went through a path that, you were very close to crashing 10 times, you were speeding, right? It doesn't tell you the full story, just that you went from A to B. When you have the full transparency, it will lead to more questions, but ultimately it does lead to more trust.
More questions and also more emotion. And the emotion can sometimes distract from getting to your end goal.
100%, 100%. And I think, Priya, just to close up, if you look at Bitcoin purely as an asset, right? Forget about why it's here, how it's built, the protocol, the fact that it's immutable, forget about all of that, right? But if you just look in terms of like return, risk, and correlation to other asset classes, it already fits in pretty much everybody's portfolio, right? You can run that. You can run any asset optimization software that you want. You include Bitcoin just because of the lack of correlation that it has to other asset classes. It already fits in a portfolio. So the question is, given my risk appetite, right, and your risk appetite, how much should you have in a portfolio? I can tell you that zero is never the right answer because it does have negative correlation to other assets or low correlation to other assets, and it has very positive potential returns in the long term. Not only that, if you size it correctly, and if you're wrong, let's say, I don't know, something happens, Bitcoin is not here anymore, and you put, 2% of your portfolio, you're going to be sad because you lost 2% of your portfolio, but it's not going to be the end of the world, right? While if I am right that Bitcoin is going to become, the global monetary asset of the world, and it's actually going to demonetize a lot of other asset classes like gold, silver, stocks, bonds, real estate, then we're talking about something that can literally 100x from where it is right now. I don't know. For me, it seems like much better to be on the side of having some allocation and having zero allocation.
Yeah, Raph, there's no doubt that you're a proponent. So I want to get into the details and help build the argument and understand the argument, really. But before we dive into the details, let's zoom out and just from a big macro perspective, can you tell us, just for context, what percentage of the world's investable assets are currently in Bitcoin?
Yeah, very, very, very little. So Bitcoin is let's round it up, around 2 trillion asset class, right? Compare that with real estate, it's a drop and a drop and a drop on the bucket, right? It's less than a fraction of a percent.
So there's still time.
Oh, it's super early. Like one of the models I actually wrote in the past was exactly putting probabilities around, if the fact that Bitcoin could demonetize these asset classes, even if you put very low probabilities that it could happen, the value of Bitcoin should already be much higher than where it is right now, right? And I truly believe there is a lot of room. Like the world needs, hard assets. This is why people invest in real estate. You don't buy real estate because you want to have a second house just sitting there or a third house just sitting there. It's because usually, people rent it out, will get some value out of it, right? And in the long term, they have this. It's a wrong perception, but they have the perception that the value is going to go up a long time.
That's a different podcast episode, but you're not wrong.
Yeah, if you put, maintenance, insurance, like your time that you're spending on all of that, 99% of the time it's not worth it, right? But people need to do it because they need to store their value somewhere. And this created this, perversive culture also that, you now, even if you have nothing to do with finance, right? You're a doctor, you're a lawyer, you have to be educated. That's people that you work with every day. You have to be educated in finance because the reality is that you have to swim against the current, right? If you just stay stopped, you are going to be debased, right? And when I talk about hyperinflation in the sense of Brazil, it's hard for people to relate. But the reality is that the U.S. has inflation, has asset inflation pretty much everywhere because the money needs to go somewhere, right? Money is printed, it needs to go somewhere. And it usually goes through these assets that people think that they can store long-term as a value of money, right? And as I said, it's real estate is a big one, bonds, stocks, the fact that again, a lawyer, somebody that has nothing to do with the stock market, has to understand the stock market, is looking at stocks, right? It's a reflection of this, the fact that if you just leave your money sitting in the checking account, good luck with that. When you wake up 10 years from now, it's going to be worth much less.
Clearly, there's still time, and just a fraction of a percent is actually what's taking up space in Bitcoin, but there's a lot of room. I want to start at the beginning. Let's talk about Mr. Nakamoto, Satoshi Nakamoto. Where did Bitcoin come from? And definitionally, simple definition, what is Bitcoin?
Bitcoin is digital currency at the end of the day. Where it came from, it doesn't matter that much because the fact is we know exactly what it is, right? So just a little bit of history. So when Satoshi launched Bitcoin as a protocol, because Bitcoin is a protocol, the same way that, email and TCP/IP is a protocol where how value in this case, messages are being translated and conveyed across the internet. It's the same thing. It's a protocol, so money can be, directed peer to peer. So I can transact with somebody digitally directly without needing a trusted counterparty in the middle, right? That was the whole goal of Bitcoin, is through money without, as I said, without rulers, with rules, but without rulers, right? So it's 100% transparent. Like the coin, when he released this through the road, he released the code base for Bitcoin. So different than when you buy your Office or your Word or your Excel, right? Where you have no idea what's behind the code. This is an open source code. Anybody can download it. You can read it. You understand what the rules are between, when is a Bitcoin transaction valid? How is it structured, right? What is a valid address done? How does the cryptography work? So all of this is extremely transparent. He wrote a white paper. I encourage everybody to read the white paper. It's very technical, but it's short. It's a few pages long. And even if you don't understand the technical part, there are, as things that I mentioned, like no trusted third parties. So it's the thing. You have your bank, you log into your Bank of America account. It will tell you have, X number of dollars there. You're trusting the bank. You don't know if the money is there. You don't know where the money is, right? Probably the money doesn't even exist because it's all digital and created in databases everywhere. Here, the ledger of Bitcoin, where the transactions sit and the balances sit, it's fully transparent. So if you know a Bitcoin address, you can track it. You can see, how much Bitcoin is on it, when it sends transactions to other addresses. You, of course, don't know who owns that address, but the address is fully transparent, right? So it's already a much more transparent and more verifiable ledger than what you would have in the traditional banking system. That by itself, gives you a lot of value, right? When you think about that, think about gold, right? Let's go back even before Bitcoin. Why did we use gold? Well, we use gold, or back in, I don't know, 100 years ago, because it was something hard to find, right? You don't have gold everywhere, so scarcity is a big thing about it. And back in the day, it was easy you can move around, gold coins without much work, right? As gold got more and more valuable, that became harder, because then the physicality of gold actually was its limit, right? You can move value really, really well along time, but you can't do it across space. Good luck getting all your wealth in bars of gold and going across an airport, right? I guarantee you're not going to go through TSA. And even if you do, if you get to Brazil, for example, I guarantee your gold is not going to make it there with you.
Again, another podcast.
So Bitcoin solves that, right? If you have a hardware wallet in Bitcoin, that's the other thing. I can custody Bitcoin on my own. I don't need a third party, right? I can have a hardware wallet that will be the signature device for my Bitcoins. And I can take that. It looks like, any other, maybe like a YubiKey or a security thing, or one of those things that you use. It's something small, like a USB key, right? And I can take literally, you could take billions of dollars across a border without anybody really knowing what it is, right? Another thing that when you think about what impacted me, how I actually started to grok Bitcoin, I remember the story about my grandparents when they had to leave Europe because of the war and come to Brazil. They left everything behind. My grandfather used to tell me, like, oh, we had all this art, gold, like couldn't bring anything. Like they came to Brazil to start their lives again. And Bitcoin solves that. Like you could literally get the USB port and you have a lot of your money that can be, condensed in that sense. So there are a lot of things that Bitcoin solves. Does it solve everything? Yeah. No, but it's already a huge evolution from where we were, I think, in terms of money.
Can you talk a little bit about the limit? Like why is there a limit on how many Bitcoins can ever exist, and why does that matter? You've touched on it a little bit, but I think it would be helpful to understand what happens after all the Bitcoins are mined. Then what happens?
The way that this works, I'll try to explain without being very technical again. So every 10 minutes, a new Bitcoin block is found, right, on average. And I'll tell you why it's on average later. But it's on average every 10 minutes. When a block is found, whoever mined that block gets paid a Bitcoin incentive. So right now, for every block, it's 3.125 Bitcoins, right? Every 4 years, this is divided by 2. So the issuance, it started at 50, then it went to 25, 12 and a half, 625 and 3 and 1/8, which is where we are, right? So every 4 years you have an event that is called a halving in Bitcoin. So what that creates is that in the beginning you had a lot of Bitcoin being produced, right? So 50 every block, then it kind of went down a little bit to 25. And as we go a long time, this curve at some point is going to hit a limit because you're issuing a fraction of a fraction of a fraction of a Bitcoin, right? And there are 8 decimals. So when we are below 8 decimal points, the issuance of Bitcoin stops. So there are not any new Bitcoins that are going to be printed. It's expected that that's going to be around 2140. So there's a longer time to happen, right? What the reflection of that is, if you look at the issuance and the inflation of Bitcoin, it's a very predictable curve that started at 0, right? And it's going to touch 21 million Bitcoins. It's a maximum that's ever going to be printed, which is what's going to happen in 2140. The question everybody asks, like, okay, if that's the case, what will happen later, since, the miners, like, they are incentivized to mine Bitcoin because they're going to get the reward. In 2140, you can ask the question, well, so what's going to happen? Miners are not incentivized to mine Bitcoin any longer. Does the network collapse at that point? And of course, that's not true, because miners get 2 things. They get the reward, and they also get the transaction fees that go into that block. So let's say a new block is going to be constructed in the next 10 minutes. What that block has is transactions between different Bitcoin addresses, right? So to send Bitcoin from one address to another, it's an open market. You can say, I'm going to pay a fee. I'm going to pay 1 cent, 10 cents, whatever it is, right? It's an open market. You just say, I want to send the transaction from this block to this address to this address, and I'm going to pay a fee for it. The miners capture those fees.
Why would you want to send, what are you buying? Like, give a very simple example. And when you said you'd pay 1 cent, do you actually mean dollars and cents? Like, you wouldn't pay a fraction of a Bitcoin as the fee, you'd pay
Yeah, you pay
dollars?
a fraction of Bitcoin. I'm just saying dollars to make it simpler.
I see. Okay, yeah.
But going back to your first question, let's assume, for example, I don't know, we agree that I'm a client of yours, right? You're managing my portfolio. And I tell you, listen, going forward, I'm going to pay monthly fees on Bitcoin, right? So we got to the end of the month, and you tell me, well, the monthly fees for this month are equals to 0.1 Bitcoin, whatever it is, right? So what I'm going to do, I'm going to go into my Bitcoin hardware wallet. I'm going to say, you're going to give me an address, because the addresses are public, right? I'm going to say, okay, here's my address, right? And I'm going to get that address, and I'm going to say, okay, from my address here that I control the keys, I'm going to send 0.1 Bitcoins to Priya. And to do that, I sign a transaction, I broadcast the transaction to the Bitcoin network, and then you see it on your side, right? You see it on your side immediately. So you're going to see that the transaction was broadcasted where 0.1 Bitcoin is going from, address A to my address B. What's missing here is that I just broadcasted that. If I do nothing, I could actually, imagine that this is not written anywhere. I could broadcast the same transaction from that address to somebody else, right? And you would have what is called double spend. In order for that not to happen, you need to have a ledger that checks that, what the balances are, and that the fact that that transaction already happened between person A and person B, and it can't happen again. The way that this happens is through the block construction and through how miners actually mine the Bitcoins. And then the fees that when you send from A to B, let's say I'm not in a rush, right? I want to pay you, it doesn't happen. It doesn't happen immediately in the next block. It doesn't matter, right? I can say I'm just going to pay very small fees, close to 0. And then a miner is actually going to put that at the end of the queue. So you may come up in the next block, you may come up in 5 blocks, you may come up in 10 blocks, but you don't care because you're not in a rush, right? If you're more in a rush and say, no, I really want this to be confirmed in the next block, you're going to pay more. And there's an active market for this that it's also transparent. It's called the mempool. It's like a transaction queue where you see all transactions and whoever's paying more, whoever's paying less, and what's the expected time for final conclusion and final settlement of those transactions. Now, this is another thing we didn't touch on, which is final settlement. So after this is written, that transactions went from address A to address B, and it's confirmed in the blockchain, it's pretty much impossible. It's immutable. It's pretty much impossible to be changed, right? So there's no way. It's different than on your Bank of America account, where you can actually call somebody. There's good things and bad things. You could call, let's say, for example, there's a charge in your credit card, and you call somebody and say, well, I didn't do this, right? And they can revert it, right? Now, The fact that they can revert it should scare you because, at some point they could confiscate it. Also, they could do other things with it, which I know it sounds very foreign, but it has happened time and time again that, confiscation happened. Whatever is written in the blockchain of Bitcoin cannot be changed. It's immutable at the end of the day because it requires a huge amount of energy to actually reverse it back.
So person A wants to pay person B. Person B wants payment ASAP. So they're paying a greater fee. Is there some comparison there with like interest?
Little bit. There's definitely, a parallel to interest there because, if you really can wait longer, you're going to pay much less, right? So, yeah, time preference really comes into play here as well. But this changes, right? There are times there's like huge demand for, I don't know, for whatever reason, thousands and thousands of people decide that today we're going to transact in Bitcoin. And you're going to see, if you go, there's a website called mempool.space. You can actually visualize this. You can see the upcoming blocks, how many transactions are in each of these blocks. And at some points, you're going to see that, the mempool is like hundreds and maybe thousands of blocks deep of like transactions waiting to be confirmed. In some periods of time, it's just empty. It's like it's the next block actually has space. So you can just go in. You go on a Sunday afternoon, for example, where there's less activity in the Bitcoin blockchain, and it's usually fairly cheap to confirm transactions. While if you go maybe on a Wednesday, 9 a.m. Eastern time, it's going to be more congested. It's going to be a little bit harder, and you're going to have to pay a little bit more to get going. It's like an open market for, confirmation and for final settlement.
Okay, so your company is a Bitcoin miner. You're mining Bitcoin, you're receiving Bitcoin that you may not even need. Does that make you able to lend it to others?
Oh, good question. Yes, if we want to. So let me just go back on one piece and explain a little bit better what a Bitcoin mining company does, right? So in essence, what we do is that we convert energy into Bitcoin, right? How do we do that? So we use computers to go out and to find that next block of Bitcoin. Imagine if it was easy to find that block. Anybody could find it. You could do it like, I don't know, in your PC very easily. You would find a block of Bitcoin. That would create a problem because then it would be very easy to change also, and it would have low cost to change. It's the problem that you have with email. Why do you receive a lot of spam? Or on Twitter, why there are so many bots out there is because there is no cost in actually creating any of these. You can create thousands of emails accounts. You can create thousands of users in X, right? And you don't have any cost for that. It's very different with Bitcoin. To mine a Bitcoin block and to actually construct that block, you have to dispense a huge amount of energy. And then one block sits on top of the other. So if I want to rewrite the last block, I actually need to rewrite the current block as well. I think one of the genius things about blockchains is the fact that if you just know the last block, there's a hash, which is a very, very long series of numbers, that it's unique to that block and the whole history of it. So if you change anything in one of the blocks before, the hash is completely different. So anytime that anybody comes in and wants to change the blockchain, they would have to disperse a huge amount of energy, right, by design. This is the whole, if you read again on the white paper, one of the things that Satoshi for a long time struggled with was how can I, avoid exactly that somebody double spends, right? The double spending problem, that they can change the ledger, right? And the way he fixed that is by using a concept called proof of work. You actually have to work and you have to dispense energy, you have to spend CPU, GPU energy, or in our case, very specialized machines to do that, to find that block. As compensation for finding that block, we receive, for every block that we find, 3.125 Bitcoins, right? So a miner can do several things. So if you look, there are several public miners out there. You can look at Marathon, Iron, Riot. They're all public companies. You can read a lot about what they do. And a lot of them, what they do is that every Bitcoin they mine is that they sell it. So they're pure, financial company where they receive the Bitcoin, and at the end of the day, a lot of them will sell the Bitcoin, right? To pay bills, to pay for operations, to buy more machines, to do different things, right? You can do all of those things. In our case, we started this the opposite way. We came to mining because we like Bitcoin. We like it as an asset class. So We mine Bitcoin, we pay our energy bills, we pay, our OPEX, we pay SG&A, we pay everything that we do. We're left with an amount, and we've been holding, and this is our treasury strategy, is to hold Bitcoin in treasury, because we do think, long term, it's the best way for us to optimize ROI, right? Now, there is a market, I told you all of this because you asked about lending. There is an emerging market for lending against Bitcoin. It's actually getting very, very active, where I could use now Bitcoin as collateral to actually get a loan in dollars that I can use for other things. And a lot of miners, they will do that. They will mine the Bitcoin, and instead of selling the Bitcoin, they will use it as collateral. Typically, you can get like maybe 50% LTV on your Bitcoin today. So you put, I don't know, $100 in Bitcoin, you get $50 in collateral, in fiat, right? And you can use that to pay bills, to do other things, and then you still keep the Bitcoin. Of course, it creates other risks because now you're leveraging up, right? You have to pay interest, right? You have to manage your capital structure in a much better way than you were doing before. But definitely something that it's emerging. I think the market for lending against Bitcoin is going to grow a lot in the next few years.
Your strategy is to hold Bitcoin because you believe in it as an asset class for long-term ROI, sort of unrelated to the basics of Bitcoin 101. But who is that ROI for? Are people investing in your company and you're looking to have an ROI for them? So you've become the money manager.
Exactly. And I think mining is very financial in reality, if you think about that, right? It's like, it's not very different from BlackRock maybe going out and buying real estate and deploying capital in real estate to earn the income on that, right? The difference is that we get our capital, we deploy machines. I look at Bitcoin mining machines, we call them ASICs, as being like fixed income, bonds denominated in dollars, because I go out and buy these machines in dollars. But then every day they're plugged in, they're giving me, a stream of cash flows. Every single day I receive they're mining, and I'm going to be receiving a cash flow every single day of these machines denominated in Bitcoin, which of course is volatile. When Bitcoin is high, I'm getting paid a lot. When Bitcoin is low, I'm getting paid less, right? And managing the volatility is critical to what we do. And the only way you can manage the volatility in our case is by being lean, being being very cost focused to survive, the ups and downs of this market, which is going back to what we mentioned in the beginning. It's still a market that it's emerging. It's still a nascent market. And any new asset class, when it's being discovered, the asymmetry of information, or how I see Bitcoin, is very different than the way that you see Bitcoin, that one of your clients see Bitcoin, and the value that each of us puts through it, it's very different as well. And that creates volatility because, you're going to look at price goes up and like, oh, this is crazy. Bitcoin shouldn't be valued this much. And then you're willing to short it, right? Or to sell what you have. And naturally, you're going to have a lot of volatility. As you walk towards closer and closer, this asymmetry of information actually converging, then volatility starts to go down, right? So a lot of people look at volatility as a negative, like, oh, Bitcoin is super volatile. I look at it as a positive because in my view, it's kind of like, a temperature check that tells you that it's early because there's still this huge asymmetry of information among, market participants.
That's a good segue into talking about Bitcoin as an investment. Let's start with if you had to compare it to another asset class, we would all be familiar with any other early asset class. What would you give us as a benchmark that would feel more comfortable and known to us?
I think the natural one is to talk about gold. I think Bitcoin is digital gold in a sense, in the fact that, it's scarce the same way that gold is scarce, right? The big difference is that we didn't get into this, but the issuance is written in protocol. So gold price just went up a ton. I know a ton of investors now, they're going out and, building more mining facilities. They're actually looking to get more gold out of the ground. So typically what you see is that the booms and bursts are embedded in the commodity itself, because as more people go out, find more gold, the supply is actually going to go up substantially. There's going to be more gold, and then price eventually collapses, right? It's different from Bitcoin. It doesn't matter. I can unplug all my machines and I can plug in 10x the number of machines I have right now. But the difficulty in Bitcoin, it adjusts up and down every 2 weeks. So if there are more people mining, it becomes harder and harder to mine Bitcoin, right? That's why I told you in the beginning that it's on average every 10 minutes, because it could be a little bit less if you have more and more people mining. But then in 2 weeks, it resets. And if you look a long time, the difficulty in Bitcoin actually it's growing exponentially, like because there are more and more people mining it. The issuance curve, which is what matters to us, right, didn't change. It's the same. It's still going to end up at 20, 21 million, no matter how much harder I mine. And I think that's, another advantage that Bitcoin has compared to gold. The disadvantage that it has to gold is that it, doesn't have a track record like gold. Gold has been around for, thousands of years, and people are familiar with it. They understand it, you see the value in it. A lot of people talk about, it's physical also. I can see it. I don't buy that because, more and more, I think we live in a world that being physical doesn't matter, right?
Yeah.
But it is another advantage. Like you can use gold for, for bracelets and other things, and where you can't do it for, I can wear my Bitcoin hardware wallet, but it doesn't mean anything.
That would be a fashion statement for sure. So back to Bitcoin in the portfolio, just going to ask a very straightforward question. The answer is yes, but like where? Does Bitcoin belong in a diversified portfolio? So assuming yes, but as an investment, as a like hedge or something else? Like again, I'm talking to high earners in their 30s who are at the earliest stages of their wealth accumulation, who really want to set themselves up for long-term growth, proper investing, not gambling, because that's the problem with Bitcoin is most people still see it as a gamble. So take us to the world of investments and talk about Bitcoin within a diversified portfolio, how to use it best.
Let me start with the pure mathematical answer to that. So if you actually look, as I said in the beginning, and use any asset allocation software, right? And what you do in these software is going to say, okay, here are the assets that I have. Here's how much risk tolerance I have. And then it would flip and it would try to find the optimal asset allocation, given, let's say you say I'm going to have S&P, bonds, real estate, Bitcoin. And what it will tell you is that, okay, given the amount of risk that you want to take, if I want to take very low risk, the software is going to tell me, well, put a lot of money into bonds, very little into equities, right? And so on. If you run these softwares and you include Bitcoin on it, every way across the whole we call this the efficient frontier, right? The frontier where we optimize the Sharpe ratio as we were talking, or maximize the Sharpe ratio as we were talking about. Every point along the way, there is a role for Bitcoin. So for somebody that is very risk averse, it's going to be, a fraction of a percent. For somebody that is more risk tolerant, it's going to be, several percent terms. So mathematically, this already answers itself that, it should have a place in asset allocation. Now, the big question, it's great, but this is all, you need to put assumptions, right? So you need to have assumptions around what the future returns of Bitcoin is going to be and what the future volatility of Bitcoin is going to be. And none of us know that, right? It could be that Bitcoin, if you look since the origins, it has a compounded annual growth rate of like more than 60%. But who knows if that's going to be the case going forward, right? Probably not, because you have marginal negative returns a long time. But anyway, it's still an important point. But if you just use history as a guide, absolutely it should fit in any portfolio. Your second question around looking at high earners still in their early age, I actually think it's the best asset they can hold, because when I don't know, if you're somebody that it's earning, I'm going to make numbers up, I don't know, $10,000 a month, right? And you have to pay rent, pay everything. And then at the end of the day, you're left with like $1,000. If you start saving that in bonds, good luck accumulating a lot of value in a long period of time, right? You actually need to have some bang for your buck. You actually want the volatility, right? Because we think about volatility, we think volatility is a distribution, right? It's going to mean that you have more potential upside, but also more potential downside. You want to have assets that, first of all, would have volatility because you can capture that upside. Ideally, you want to have more upside volatility than downside volatility. Hard to find these assets, right? Going back to what we discussed in the beginning, when you think about Bitcoin and the fact that, it is an asymmetric play right now, it is a little bit of gambling. You're not wrong with that, because if you're wrong, there's still, I think it's very low probability. I think it's right now, I actually don't think this could happen, but there is an event that Bitcoin could go to zero, right? I put that at very low probability. But then on the flip side, there is also a scenario where Bitcoin captures a lot of the monetary premium that we talked about. It becomes, the unit of account for the world. And you can say that that's also a very low probability. But if that happens, just a couple percentage points that you have in your portfolio that you put a long time, it's actually going to make a huge difference, right? The other thing we talk a lot, particularly I think with younger investors, I always tell them this, is that, make a decision that you want to allocate something to Bitcoin, and doesn't need to be a lot. Just start, we talk about stacking sats, right? Sats are the units of Bitcoin. Just every month, buy a little bit, because then the volatility can work a little bit in your favor. Some points you're going to be buying at lower prices, right? If you bought last year, you would have bought above $100,000. Now you can buy below $100,000. And you're just constantly, dollar cost averaging into a position. I don't know, maybe in 10 years' time, you would have amassed like a significant position in Bitcoin, and your basis is going to be very, very good because you bought a long time, right?
Okay, so to take that and to distill it into stash wealth language, we think about investing for short, mid, and long-term financial goals. And if I'm understanding you correctly, it's that Bitcoin deserves a place in a short-term, mid-term, or long-term portfolio. It's just the amount that you want to distribute to Bitcoin, since it is a more highly volatile asset class, given that it's early in its life cycle. So just really getting very basic with it, it's almost one step above equity, like bonds, then equities, and then Bitcoin as far as like volatility and long-term return potential.
Exactly. My suggestion, set a percentage that you think is appropriate for you. I don't know, and not for today. Let's say your portfolio today is 60-40, just to make it simple, right? And say, well, by the end of the year, I actually want to have 5% in Bitcoin. Don't sell your stocks, don't sell your bonds, right? Because if these people have the advantage that they're still building their portfolio, they still have, dispensable cash at the end of the month. Just set it that, going forward, you're going to allocate maybe more to Bitcoin than you are to the other asset classes. So that at the end of the year, you are going to have a 5% position in your portfolio that was derived from, buying Bitcoin along every month for a whole period of time. It's a less risky way to do it, and also probably more tax efficient because you don't have to sell any of your positions, right? You're just building up with time. You're going to be building to get to a larger percentage of your portfolio.
Yeah, it sounds like you're talking about adding a Bitcoin percentage and then rebalancing slowly into your way into it.
Yeah, exactly.
Yeah. Okay, so owning a small amount of Bitcoin could be meaningful. It doesn't need to be all or nothing.
100%. 100%.
We already talked about this, but I just want to hit the point home. Is it too late to get into Bitcoin? Like, what if I think that? What would you say to me?
It's extremely early for all the things that I've mentioned. I still think Bitcoin is going to demonetize a significant portion of gold, real estate, bonds, all of these asset classes. And even if it is a fraction of a fraction, price can still double, triple, multiply by 10 from where it is right now. It kind of creates like a positive flywheel when that starts to happen because, more and more, even the conversations we're having around Bitcoin today were things that, we couldn't even think about having 10 years ago, right? As I told you, like I got laughed at Deutsche when I mentioned Bitcoin. And now it's an institutional asset class, right? Now you have ETFs. Now you have, established lending market. You're starting to have, bonds that are going to be denominated in Bitcoin. All of these things are happening, and it became an institutional asset class. The risks that we had 10 years ago of Bitcoin just being banned, and I think these are gone because now it's part of the, of the financial market system. And I think this is actually going to start feeding on itself. I think you're in a much better risk-adjusted position to buy Bitcoin today than you probably were 10 to 12 years ago because there were massive risks, right? Those risks are gone. And the upside is still here.
Does that scare you a little bit that the financial services industry is more and more interested in Bitcoin? Because it feels like any time Wall Street gets their hands on anything, it's just like, stay the fuck away.
Yep. We've lived for it, right? We saw Merrill Lynch collapse exactly because of the irresponsibilities of Wall Street. It does scare me, but I do think Bitcoin is bigger than all of that. They will try, like with the ETFs, there is going to be a lot of things that are going to happen. But the difference is that, the protocol, it's still there. We still know what it is. So we can now, if the financial system breaks, we can just escape to the real thing, which is Bitcoin. And that's the other thing that maybe you should think about, longer term is like people always ask, like, so how should I buy Bitcoin, right? I want to put in my profile. How do I do it? Having an ETF is better than having no Bitcoin. So buy an ETF. You can have, it's so super easy. You can buy in a brokerage account. It doesn't matter. The ideal thing is that you learn enough and you get comfortable enough and you at least understand how you can take self-custody of your Bitcoin. And there are several companies out there that can help you with that, like Unchained and other companies, where basically you go and you have, the signature devices. It's self-custody. The custody is with you, right? And you can have it in a way that you have multi-signatures, different devices in different locations. Don't try to do that on day one, because you're probably going to make a mistake, and you're going to be too afraid. Just buy an ETF, right? But with that, start learning. I think one of the things with Bitcoin, we always joke, like, people that get in Bitcoin, they tend to fall into the rabbit hole and they start to read, they start to understand, they start to learn more, and then gradually walk your way towards self-custody at the end of the day. Then you can, in the meantime, you can maybe open an account in a Bitcoin exchange and buy some Bitcoin there, right? And then eventually move it to your own self-custody.
You are definitely a crypto bro, but an atypical one, which helps the rest of us feel a little bit more comfortable.
I'm not a crypto bro. I'm a Bitcoin. That's the other thing, don't fall into the natural trap, which is, we've seen this time and time again of the new currency, the new Bitcoin, a much better, faster Bitcoin. It doesn't exist. There's only one cryptocurrency, which is Bitcoin. It has the track record. It's been around for a long period of time. It has the network effects, right? And it's natural. This happens a lot. That somebody will come in just like you, like, oh, I'm too late for Bitcoin. I'm going to buy, I don't know, this XYZ coin that is coming out here because I think it's the new Bitcoin. I guarantee you're going to lose money, right? Just buy Bitcoin, wait for it, have low time preference, and in the long term, you are going to succeed. Just think in, 4 or 5 year cycles. Anything you allocate to Bitcoin is super important. Anything you allocate to Bitcoin, you should never think about holding it for less than 5 years. That's what I always tell people. You're going to buy it, you're going to forget it, set it aside for 5 years. At some point, it's going to be worth half of what you put in it. Some point, it's going to be worth, 5x what you put in. Don't feel emotional in either of these scenarios. When it's down 50%, it's probably the right time to be buying more, not to be selling. And when it's up, 10x, it's probably the right time to be reducing your exposure, not to be buying more. But I guarantee you're going to feel exactly the opposite way, right? So lock it in for 5 years so you know that you feel at least, a full cycle, and it should work out well. You never had a period of time longer than 4 years where Bitcoin went down. So
that's the classic framework and advice and guidance that we give for other traditional assets. That makes a lot of sense. And so from a goals-based investing perspective, short-term goals, you still want to keep that over at a high-yield savings account. Usually, this is not financial advice on this podcast, obviously, but midterm, long-term, when you have time to work with, now you can look at Bitcoin.
Exactly.
So for someone listening who still isn't sure how they feel about Bitcoin, what is one thing you hope that they take away from this conversation?
Yeah, as I said, buy slowly, buy a little bit every month, right? Start learning slowly. Don't try to understand everything at once. You won't. As I told you, I'm still learning. And, just go from there and think about it as just being any other asset. I guarantee none of your clients, when they invest in Apple, Google, whatever stock, that they're reading all the 10Ks and 10Qs, every month. They are not, right? They shouldn't try to do the same thing with Bitcoin. Just think about this as being, a new asset class you're investing in. Start small. If you're wrong and price collapses in your face 50%, you're going to be fine, right? You're just going to be buying more, and think about it in the long term.
I will link to the white paper in our show notes. So for people who are interested and want to get into the nuts and bolts, they'll have access to that there. Okay, this has been insane. Before I let you go, Raph, we probably all need a bit of a palate cleanser. That was a lot of Bitcoin talk, very informational. But we always like to end with a segment that I call Best Bite. You definitely know I'm a foodie. We've had many amazing meals together, and I would love to know, what is something that you've had recently that is just absolutely blew your mind? You're based in Miami at the moment. Maybe it's something you've gone out to eat. Give me a recommendation. I want to know where I need to go and what I need to order.
I'll tell you, I had a friend who just barbecued a tomahawk for us recently that was amazing, amazing, really, really, really good. As a Brazilian, it's hard to impress me with steak, but I really got blown away. Yeah, I don't know, steak. I really like American steak. It's different than Brazilian steak. I would say like depending where you go in the world, right, you're gonna enjoy different kinds of cuts. You can't get like a very good, for example, a New York strip. You can get it in Brazil, but you can get a
Okay.
picanha in the US as well. So, and you can get like a very good beef of chorizo in Argentina, right? So,
That works. That works because I'm a big meat eater. And so now you put tomahawk on the brain, and I have to go find a really, really good tomahawk. That's awesome. Nothing better than a friend who will cook you a great meal. Finally, Raphael Zagury, where can people find you, follow you? Tell
yep.
us where your channels are so that we can stay in touch and follow all of your interesting work.
Yeah. So first of all, I encourage everybody to follow our company, Electron Energy. It's at Electron Energy at X. And then my Twitter profile, my X profile, it's Alpha Zeta. It's ALPHAZETA, Alpha Zeta. I used to be an anonymous Twitter account for a long period of time. Now I'm not, but I kept the handle, because a lot of people still know me by the handle. So those are the best two places to go for to get more and to follow me.
Awesome. And we'll drop all your links into the show notes so people can stay in touch with your journey. Raph, thank you so much for joining me today. I really appreciate how you walked us through this topic that is definitely surrounded by a lot of noise, hype, and fear. But for those listening, if this episode helped Bitcoin feel a little less intimidating or gave you at least a framework to start thinking about whether or not you want to learn more, that was our goal. That was definitely the goal for today. Just walk away a little bit more informed and have a wider vocabulary to be able to talk about Bitcoin. You definitely don't need to pretend that you understand something if you're still learning, and you definitely shouldn't invest in things that you don't understand. Clarity beats confidence every single time. If you found this episode helpful, please make sure you're subscribed to the channel so you don't miss future conversations. And a quick favor, a rating, a review, liking, subscribing, all those things really help other people find the show. So if you have a sec to do that, we really appreciate it. And if you know someone who could use this episode or have a crypto bro in your life who's very convinced that he's cracked the code by putting 100% of his net worth into one asset, maybe you should share this with them, for educational purposes. All right, that's it for today. Thanks for listening. We'll see you next time.
Thanks for listening to The F Word with Priya Malani. If you like what you heard, hit subscribe wherever you're listening and leave us a review while you're at it. We're approval junkies. Don't forget, you can find a ton of great resources, content, courses, and other freebies at stashwealth.com. Now, for the capital S stuff our lawyers want us to say. Stash Wealth is a registered investment advisor. Content presented is for informational and educational purposes only and is not intended to make an offer or solicitation for any specific securities, product, service, or strategy. Consult with a qualified investment advisor, that's us, before implementing any strategy. Investing involves risk, including the loss of principal. Past performance does not guarantee future results. There, we said it.
Did I have that up?